The extreme weather events that have hit the U.S. and other countries this summer have cast a sharp spotlight on the role of climate change. In recent years, those same concerns have changed the way that major investment firms and some companies do business. Economics correspondent Paul Solman has more on the backlash that's brewing.
On Wall Street, New York City Comptroller Brad Lander.
A big part of investing is investing across the stock market.
And that's how you protect your portfolio against risk.
Diversification protects you against concentration risks. Looking at your environmental and social and governance risks protects you against systemic risks.
Lander oversees over $250 billion in assets in pension funds for 750 New York City teachers, transit workers, and other public employees.
If you have retirement obligations, pension obligations out decades, then climate risk is financial risk.
In Lander's words, taking into account a firm's environmental, social, and governance, so-called ESG risks, is his fiduciary responsibility as a long-term investor. That includes, he says, reducing greenhouse gas emissions in the portfolio to near zero.
We've adopted the most ambitious net zero plan of any U.S. public pension fund. We are aiming to have three of our 5 funds be net zero by the year 2040, so pretty soon.
In 2021, 3 of the 5 New York funds he oversees divested $4 billion from fossil fuel stocks to mitigate risks associated with global warming, he says.
If we have disruption of the food supply, if we have an increased number of climate refugees, if we have more real estate, can't live in because it's underwater or it's just too hot, all of those have big financial costs.
By the end of last year, ESG investments nationwide totaled $8.4 trillion, 13% of total U.S. assets under professional management.
Incorporating E factors within ESG for us is something that's just a matter of good, solid, prudent investing.
Portfolio manager Dan Abbasi applies the E, environmental metrics.
If we have increasingly dangerous problems like climate change, the companies that are selling solutions to those, there's opportunity to grow and be competitive, but also an opportunity to have favorable impact on society. And we see those as flip sides of the same coin in many cases.
It's an existential threat.
But these days, there's a political backlash against this ESG investing as so-called woke capitalism.
It's not their job to pursue political agendas.
Congressional Republicans have taken up the issue.
It's their job to actually manage the accounts for return on investment.
A GOP bill to prevent pension funds from considering ESG prompted President Biden's very first veto. So states have taken up the anti-ESG cause.
In Florida, we signed legislation nixing ESG from our pension fund because we don't want political agendas to interfere with the pensions of our teachers, our firefighters, and our police officers.
This year, 165 pieces of anti-ESG state legislation have been introduced, 22 of which have become law.
Investment outfits that are not investing in the oil and gas industry from here forward, they are therefore deemed boycotting the oil and gas industry.
In Texas, Comptroller Glenn Hagar has a list of financial institutions now banned from doing business with the state government because they boycott energy companies.
If someone else can do this job, then go with those. Don't go with the entity that's boycotting the oil and gas industry.
The Texas Comptroller's Office has already pulled several $1 billion from the likes of investment giants BlackRock and UBS.
If we had no more petroleum in this nation, in this world, you would shut down most functions of the economy.
And in New Hampshire...
My name's Vivek, it rhymes with cake, and I'm on the campaign trail having some fun.
One-time Harvard undergrad rapper, Republican Vivek Ramaswamy, who went on to make mega millions as a hedge fund and biotech honcho.
Fossil fuels are a requirement for human prosperity.
He's now campaigning for president, in part on an anti-ESG platform.
What's actually driving it? It's the politicized demands of asset managers, and I think that is a political agenda masquerading as value maximization.
And ESG backlash is having real impact on asset managers, including the world's largest, BlackRock, whose CEO, Larry Fink, is on the defensive.
There has been a rebuke, if you will, to what some people call woke capitalism.
I believe stakeholder capitalism is not political, it is not woke, it is capitalism.
But today, Fink no longer publicly embraces ESG. And he's far from alone, says Harvard Business School's Rebecca Henderson.
And when one political party decides that firms acting in this way is not appropriate and is willing to use their power to enforce that, many managers say, oh, okay, I'm going to be careful. At the very least, I'm not going to talk much about it.
But how well have ESG investments actually fared? In New York, 4 city employees sued the pension plans that shed fossil fuel investments, alleging they breached their fiduciary duties. Fossil fuels have done quite well in recent
well, it depends
anyway.
what time horizon you look at. They had a brief window. If you look over a longer period of time, they have not actually been doing very well at all. So our funds are in strong position. If you look at our 1-year, our 3-year, our 5-year returns, they're really actually quite strong, given all the decisions that we've made.
Ramaswamy says he doesn't buy it.
Disguising this agenda in the guise of value maximization is a farce.
So the New York controller who tells me that he's trying to invest in the long-term interests of his pensioners is lying?
I believe he's not telling the truth. That's correct.
But Dan Abbasi points to official data that his environment-focused investing has paid off.
Our strategy has outperformed now benchmarks like the S&P 500 and the MSCI World for 6.5 years. You know, this idea that it's an ideological issue, for us, it's just a prudent investment agenda that's very clear-eyed about the way the world is changing.
So I asked Ramaswamy, is it ever the case that a company would say in good faith, it is in the interest of our shareholders to maximize value by taking ESG into account?
Maximize shareholder value. So do whatever requires taking maximized shareholder value into account. But the little puzzle at the heart of this is why these particular 3 letters in that acronym had to be the one factor they take into account. That should raise suspicions.
And yes, some studies show ESG investing in general has led to lower returns in recent years. But proponents point to the long term.
It's as if we're stuck in an old way of thinking about the world and an old assumptions about how to make money, and that we just haven't understood that the world is fundamentally changing.
And Henderson argues monetary returns aren't the only metric we should be using.
Not to pay attention to what's happening to the climate, not to pay attention to the consequences of inequality for the society we're in, not to be aware of the new products and opportunities that dealing with these issues is going to create, is to be blinkered and short-sighted.
Yet Henderson is also skeptical of so-called greenwashing firms who use ESG mainly as a marketing device.
There are companies that have just said, yeah, we need ESG, go measure it, stick it in the PR department, and they aren't really being used to govern the firm, and they aren't really useful to investors. So that is true. It is also true that some of the things that people are trying to measure are hard to measure. But to me, that sounds like reason to improve the measures, not to get rid of them altogether.
In the end, the debate may come down to time frame. Shareholder value in the more knowable short run, in contrast to the less knowable but ever more threatening future.
For the PBS NewsHour, Paul Salman.